Hey there, Mark from Caliber Home Loans. Happy Halloween. We're going to just cover the markets real quick for the past week and go over past charts and just see where we're headed, where we think we're headed. So let's go ahead and dive right in. So you see this is the chart for Friday. So a little choppy, but again, we didn't cover a lot of ground as far as pricing. So let's look at the past week. You see that we started a little bit lower in pricing than we finished. So again, price and rate run in opposite directions. As the price goes down, the rate goes up, and vice versa. We did see some as we got into Wednesday. We saw some downward pressure on rates as the price went up a little bit, and then we saw from really late Wednesday to Friday, pricing came back down a little bit, which pushed the rates up just a hair. So let's go ahead and look at the past month. You'll see that there's certainly a downward trend in the price. So as the price goes down, rates go up. So there's definitely upward pressure on rates over the last month. And then you'll see that we were at our high right around August, mid-August, and then since then rates have been under a little bit of pressure. But again, we're still doing mortgages at under 3%, depending on what the situation is. So let's talk a little bit about what happened this past week. The Dow lost 900 points one day and had almost no effect on the bond market, either the government bonds or the mortgage-backed securities, which is kind of unusual, but we're in unusual times. So remember that typically when the stock market dumps that much in one day, a lot of that money goes into bonds. When there's that much money going into bonds, it pushes the prices up, which pushes the yields down. That really didn't happen much. It didn't happen in the 10-year in the government bonds, and it didn't happen in the mortgage-backed securities. And again, part of that reason for the mortgage-backed securities is nobody wants to own them, except for the Fed. So a lot of that money went into cash, and that money will come back out of cash and go back into the stock market when people think that it's a buying opportunity. So let's go ahead and talk a little about what's coming up next week. There's some reports coming up next week. The ADP employment on Wednesday, not quite as important as it used to be. Weekly jobless claims, that's a big deal. That's coming up on Thursday. The Fed meeting adjourns on Thursday. That'll be a big one, although we don't really expect any changes at all. And the employment numbers come out on Friday. So we think that, or they think that employment will be up 7.7%. Or payrolls will be up 700,000. So again, all things being equal, if they think payrolls are going to be up 700,000, if they're up higher than that, typically it's bad for bonds because it's inflationary. If they're up lower than that, then it's good for bonds because it puts less stress on the economy. So it is what it is. But again, because the Fed's in there spending $100 billion a month, a lot of the normal pressures and responses from the bond market to the economic reports just isn't there. So again, it's still a great time to buy. It's a great time to refinance. There's still ample opportunity to take advantage of this market. If you have any questions, give me a shout, 248-705-8431. Thanks and have a great day.